Okay, so you own a stock. Have you ever stopped to think about how the company's profits actually get back to you, into your pocket? You always hear about two main ways, right? Dividends and buybacks. The story goes that dividends give you cash and buybacks make your stock price go up. It sounds pretty straightforward.
But is it really that simple? Well, as you can probably guess, not exactly. In fact, one of those ideas is often pretty misleading, and neither one really tells you the whole story. So let's peel back the layers and figure out how your investment truly pays you back. Let's start by tackling the biggest myth out there when it comes to dividends. This whole idea that there's some kind of a bonus or free money the company gives you just for being a shareholder.
Let me be crystal clear about this. Dividends are not free money. That cash has to come from somewhere, right? And it comes directly out of the company's value. It's not a bonus payment. It's really more like you taking money out of your left pocket and putting it into your right pocket.
This all happens on a specific day called the ex-dividend date. And on that day, the stock price is automatically, mechanically reduced by the exact amount of the dividend. So if you have a $50 stock and it pays a $1 dividend, it will literally open for trading the next day at $49. No new wealth is created here. It's just a simple transfer of value from your stock holding into your cash account.
Let's make this real with a quick example. Imagine your shares in a company are worth 500 euros. Now, the company wants to return some cash to its owners, and they have to choose, do we pay a dividend or do we do a stock buyback? Okay, take a look at these two paths. In path 1, the company pays a dividend. Your shares are now worth less, 450 euros, but you get 50 euros in cash. In path 2, the buyback, your shares are still worth 500 euros, but because the company bought up some shares, your slice of the pie got bigger. You own more of the company. Now, look at the bottom line. It's the most important part. In both cases, your total wealth is identical, 500 euros. This is what's known as economic equivalence.
So, in a perfect world, your total wealth doesn't change one bit. It's just a choice between getting cash in your hand now or owning a bigger piece of the company. But, as we all know, we don't live in a perfect world, and this is where things get interesting. Because in the real world, there's a catch. And this is where that simple story about buybacks always pushing your stock price up, well, it starts to fall apart.
And that problem has a name: dilution. You see, while a company is out there in the market buying back its shares, it's often quietly creating and issuing brand new shares behind the scenes.
Now, why would they do this? Well, the most common reason is to pay their employees with stock-based compensation. Or maybe they issue new shares to buy another company, or just to raise some extra cash. Whatever the reason, these new shares are working directly against the buyback. It's like trying to bail water out of a boat that has a leak.
So picture this. A company makes a big splashy press announcement about a huge buyback. Over the course of the year, they go out and repurchase 3 million of their shares. And that's the big number you'll see in all the headlines. But here's the part they don't shout about. During that exact same time, they also issued 1 million new shares, mostly to employees.
So what's the real story here? Well, they bought 3 million, but they also created 1 million. The net change, the number that actually matters, is only a reduction of 2 million shares. This is exactly why you can't take those big buyback announcements at face value.
Okay, so with all this noise and all these moving parts, how can you figure out what's really going on? How do you get to the truth? Well, thankfully, there's one single metric that cuts through all of it and gives you the actual picture.
It's called shareholder yield. And honestly, if you only remember one thing from this whole explainer, make it this. It's so powerful because it cuts out all the corporate spin. It combines the dividend you get paid with the net value of the shares that were actually bought back and retired. It's the total real deal cash return you get as an owner.
And the best part is, it's actually pretty simple to figure out. You just start with the company's dividend yield. Let's say that's 2%. Then you find the net buyback yield, which is the percentage of shares that really disappeared. In our last example, that was 2%. Then you just add them together.
And there you have it, a 4% shareholder yield. This is the number that tells the true story. It tells you that the company truly returned 4% of its value back to its owners through a combination of dividends and a genuine reduction in the number of shares out there.
Okay, so now we know how to measure the cash a company returns. But, that brings up an even bigger, more important question. Should they be returning that cash in the first place? Or should they be putting that money back into the business to grow it even more?
This is probably the most important question in all of finance. It's called capital allocation, and getting it right is the #1 job of a company's management team. And lucky for us, there's a simple, powerful way to think about it.
Think of this as the golden rule. It's all about comparing two numbers. If a company can take its cash and reinvest it in projects that earn a return on invested capital, or ROIC, that's higher than what investors expect to earn, then it should reinvest every single penny. That's how great companies get built. But if its internal projects can't clear that hurdle, then the smartest, most honest thing to do is to give that cash back to you, the shareholder.
All right, we have covered a ton of ground. So how can you put all of this into practice and check out a company's payout policy for yourself? Let's boil it all down into a really simple, actionable checklist. Here are the 3 crucial questions you should always ask. First, what is the net share change? Forget the headlines, dig into the reports. Is the total share count actually going down over time? Second, is that dividend safe? Make sure it's being paid from free cash flow, the actual cash the business generates, not by taking on a mountain of debt. And third, is this the best use of cash? Look at their return on invested capital. If it's really high, reinvesting is a great move. If it's low, they really owe it to you to pay that cash out.
So there you have it. You're now totally equipped to see past the smoke and mirrors and understand how cash really finds its way back to shareholders. But this brings up a fascinating follow-up question. Since we know buybacks reduce the share count, they have a direct impact on earnings per share, or EPS. So how does that secretly warp the most common valuation metric you see everywhere, the PE ratio? We're going to dive into that in our next explainer.